All right, thank you. Okay, today we are going to look at the next chapter, that is financial intermediation and regulations. So this might be the last one from me, and other chapters will be continued with another lecturer, right? Okay, so you all can ask any question, right? And I just want to reiterate that like the questions, right, you'll get most probably from the discussion we had, right? So you can read the books references given, and same time you can go through our presentations and discussions again, and you could easily handle your exam, right? So today, as based on our agenda, right, we have seen the overall view of financial system, right? And then we looked at individually key areas. One is analysis of interest rates, and then analysis of exchange rates, and then monetary policy and Sri Lankan context. And now today, like financial intermediation and regulations. So financial intermediation also we have looked at in our very first discussion, right? This may be little bit covered in detail here, right? So first I will move into financial intermediation and then regulations, right? So when it comes to like financial intermediation, right, we have seen at the beginning how the interactions happen between the deficit unit and the surplus unit. So then there will be a middle level player, so-called banks. They have the intermediation between surplus unit and deficit unit. So we have discussed that extent. And then again, we are going to look into that in detail, what's happening in the banks when they manage this intermediation. So some extent we looked at that as well, and then we'll be moving towards regulations, especially in Sri Lanka. Look at this bank balance sheet, right? You can see the bank balance sheet here, right? As usual, in any entity, right, you have the formula that means total assets equals to total liabilities and the bank capital, right? When we say bank capital, that's a bank's net worth, right? So as usual, as in any entities, right? So this is the basic formula of a balance sheet. So in any entities, that means the total assets would be equal to total liabilities plus capital, right? Okay, now first look at that. We know in the liability side of the balance sheet, you can see capital, and in addition to that, you can see external liabilities. So when it comes to liabilities, in normal, like in a company or like kind of the company which into a trading business, you can see so many liabilities, right? Especially borrowing long-term or short-term borrowings or creditors. So that kind of entries you could see in a balance sheet. But in a liability side, you can see that when you see the external liabilities, the major portion of those liabilities, even the balance sheet liability side, you could see deposits. So now, as we discussed earlier, you know, a balance sheet shows source of funds and use of funds, right? So source of funds, how you are getting, on which way you are getting funds to that entity's business, right? That is a source of funds. The source of funds could be from capital or other borrowings in a usual business. But in banking business, you could see source of funds. One may be capital, other may be deposits from public, and third is borrowing. These are three major items of a bank's liability. One is capital, then is deposits, other one is borrowing. That's a source of fund. And then you can see assets, how the bank use those funds, right? In a normal company or in a trading, the company which is into trading business, you can see they might have bought land and buildings, machineries, stocks, so that kind of thing, right? But when you look at this bank's assets, so use of funds, all financial assets, right? That can be reserves or cash items in the process of collections, right? So when you say reserves, that's a cash reserve. Maybe bank may be having a liquid cash in their wallet, or they may be having reserves at Federal Reserve Bank or Central Bank. That is the reserve. Or the cash items in the process of collections, meaning there may be a check belongs to a bank A, they are waiting for that check to realize. So it's cash item in the process of collection, right? So same times a bank A can deposit its money into other banks, right? Or buy securities. Or that means they can buy treasury bills, they can buy treasury bonds, they can invest in any other securities. It can be debentures, whatever it is. And then the banks can lend their money to borrowers. So that is loans and advances, right? They can lend loans, or they can use their funds into other assets. That can be land and building, or maybe some receivables, or whatever it is. So now in a balance sheet of a bank, you can see deposits, borrowing capital, and then assets, reserves, cash items in the process of collections, deposits at other banks, securities, loans, and other assets. Here you can see there are two kinds of deposits. One is checkable deposits, right? When you say checkable deposits, right, it's a like a term, a universal term used in this kind of deposit. It's a current account we are referring. So you can withdraw money by writing checks. So that is checkable deposits. Other than these checkable deposits, we can call non-transaction deposit, where you cannot write check and withdraw money or transfer the money, right? So in Sri Lanka, okay, current account and other deposit, current account deposits and other deposits, right? Or maybe savings or fixed or whatever it is, those are the deposits. So you can see in a bank balance sheet, liability side, so deposits are huge amount. Maybe in Sri Lankan context, more than 70% is deposits. Capital is very small, maybe 20 or 15%. and balance may be borrowings. And if you take this asset sides, a licensed commercial bank, if you take a commercial bank, their major operation is lending, right? Provide loans and advances. So maybe 60% of all these funds may be used for lending, right? Same time, they also can invest. The banks can invest on securities. It can be shares or bills or whatever it is. And in addition to that, others may be lending to other banks, and all these things may be a smaller portion. So major items in the asset sides are loans and advances and investment. So loans and investment. So you can see a balance sheet, right? Okay. Now this is extracted from the book, right? So you can see what's happening in the assets and liability side in US, right? The balance sheet of all commercial banks items as a percentage of total June 17 is based on the book directly. I'm giving to you all to see what's happening, right? So if you take the asset sides, the cash and reserves are 14%. So US government agency 15, and state and local government other security is 6, right? And then you can see, right, asset sides, loans, commercial and industrial 13, real estate 26, and consumer 8%, interbank 1%, other 9%, and other assets 8%, altogether 100%. So here you could see the loans and advances are the key in a commercial banking business, right? And you can see liability side. Checkable deposits, that's a current account, it's only 11%. And you can see non-transaction deposits, that is serving deposits 49%, and small denomination time deposit 2%, large denomination time deposit 10%. So the non-transaction deposits are huge. And you can see borrowing is 17%, right? And bank capital is only 11%. Bank capital is only 11%. So now you can see the balance sheet pattern, right? And you can see the order of the items as well. You see the items in the asset sides, it's starting from cash. But if you take a normal ordinary business balance sheet, a trading company balance sheet, right, starting with fixed assets, right, land and building and all, and the cash is the final item. So the bank balance sheet always ordered based on the liquidity, right? High liquid assets are first, and very low or illiquid assets are at the bottom, right? So you could see the differences between, you know, the bank balance sheet and other company balance sheet. And also you can see this is one difference with banks and other companies. And the second difference, you can see the capital, amount of capital. If you take a normal a trading company or other than banks, you can see the capital is the major part of their source of funding. Maybe 40%, 50%, or 60%, even 70 to 100%, right? It's bank capital, right? Because that means the capital is the major item giving funds to those companies to buy their assets or run their business. But here, capital is very small, and these banks are running their business using the deposits. That's what you could see the difference, and so much of control over the banks, because like banks are running their business with public money. with deposits, not the owner's capital. So if something happened to the bank, or maybe if there's a mismanagement, that's going to affect the general public drastically, not the owners, right? Because their capital is limited. That's what you could see. There are so many regulations, so many controls, like very important entities in an economy, right? So this is the balance sheet picture of a commercial bank in US. Now I just want to explain few transactions to understand how the banks work, right? Okay, now first of all, like look at this, a cash deposits. If a customer comes and deposit cash, what will happen to the transaction? Now this is like I take based on the book example. So there's a bank, assume First National Bank, right? It's kind of balance sheet given, assets and liabilities, and now you get a transaction that is $100 worth of cash deposits. What will happen to the balance sheet? Now you get a $100 cash, then your asset is going to increase by 100 rupees or dollar, right? So when we say cash, it's a vault cash, like cash. The banks keep the cash in the wallet, so we call it wallet cash. So wallet cash increased by $100. And same time, liability side, we have seen what are the items. It's checkable deposits or like non-transaction deposits and so many things. But this is deposited into checkable deposits. So the bank's liability increases via checkable deposits. And second, the bank, First National Bank's asset increases or via vault cash. Is it clear? Yes. And you can see the second balance sheet here. Like when we say vault cash, that is, as I explained earlier, that is the reserve we talked about. So bank's reserve include the cash plus the balance at Fed. That means balance at central bank. So now you could see, so in other way we can say like reserve will increase by $100 and checkable deposit will increase by $100. So this is the transaction. So every time when you think about transaction, you keep in mind you can have a T accounts. So simply represent a balance sheet and you can think, okay, what will be the changes in the bank balance sheet? Okay, I have clearly stated there, opening of a checking account leads to an increase in the bank reserves equal to the increase in the checkable deposits, right? Okay. Now, let's assume you are going to deposit a check. So when a bank receives additional deposits, it gains an equal amount of reserves. When it loses deposits, it loses an equal amount of reserve. Okay, now we look at, now you are going to have a check deposits. So what will happen? So let's assume like First National Bank got a check deposits. So that might be written by a Second National Bank, assume like that. So always, so you can have an entry says cash items in the process of collection, because the check should be realized, because it's a check from a Second National Bank. So you have to wait for some time to realize those checks. So until such time, you can keep an account as cash items in the process of collections. So your asset side, the cash item in the process of collection would increase, and liability side, your checkable deposits going to increase because somebody has put their second national bank check into their deposit account, checkable deposit account. So you have two entries, double entries like this. So now let's, like, after that, what will happen, right? That check will be cleared through Fed account or central bank account. So what will happen now? It's clear, so you can see the first national bank account and second national bank account. Now I look at the second national banks, the customer of the second national bank who wrote the checks. So what will happen? So now it has gone to first national bank, the fund has gone or cleared through central bank account. So now gone to first national bank. What will happen to the second national bank first? So their checkable deposits going to be decreased, right, by $100 because the fund has been transferred to First National Bank. So same time, that would be cleared through reserves. So now reserves means, like as I mentioned, like, it can be cash or balance with central bank, right? If you take, right, balance with central banks, okay, so that also declined by $100. Now the check cleared. Now what will happen? So now the First National Bank's checkable deposit account would increase by $100 and its reserves also going to be increased by $100. So this will happen, right? So you have to always remember what will happen to the reserve account. So when we say reserve accounts, that's a balance, the cash with the banks or maybe central banks account, right? Okay, so we also discussed earlier, I think you all can remember, right, under monetary policy analysis. So how do we calculate this reserve, right? What do you mean by the reserve, right? Okay, now the question is how banks are making profit, right? Okay, now you have to ask yourself, right? Now the first balance sheet, you can see the checkable deposits with First National Bank is $100 now, right? So now we discussed earlier reserve requirement or statutory reserve requirement we have discussed in previous classes. So there would be a requirement from central bank, right? You have to have, right, reserves with central bank may be required with some kind of percentage on deposits. Now let's assume now every bank, they have to have at least 10% of their deposit as a reserve with central bank. Now you can see the previous balance sheet, what it says. Now when the First National Bank get a deposits, so checkable deposits increased by $100 and reserve increased by $100. Now see the first balance sheet. How much a bank should keep with central bank? It's only 10% of their deposits, right? That means when you get a deposit $100, you can keep only $10. That is the requirement. So now if you keep like $100 instead of $10, you are keeping $90 more than the required reserve. Is that clear? I repeat again. Now assume the statutory reserve requirement is only 10% of the deposits. So now when you have like checkable deposit $100, you should only have $10 as reserve, right, minimum. But if you have $100, then you are going to have $90 more than the required reserve, right? So what bank can do? Yes, they have $90 more than the required reserve, so they can lend those money to the deficit unit. So you can see the second balance sheet now. Assets and liabilities are there under First National Bank. You have checkable deposits is $100, and a required reserve you have $10. That's enough, but balance 90 you're going to lend, right? So this is through this only, like, banks are going to make profit. This is their business. This is the intermediary business, right? Even though we discussed earlier what is intermediary business and what the functions and role of banks in an economy, but in detail you can look at this. This is the way of transaction happens. This what we call asset transformation, right? That also we discussed earlier, right? So selling liabilities one set of characteristics, right, and using the proceeds to buy assets with a different set of characteristics. Here you can see the bank borrow short, checkable deposits are very short, and lend long. This is asset transformation, right? You borrow short, right, short term, and lend long term. So this is asset transformation, right? So these banks are making profits, right? This is their business. So now I just want to look at the general principles of bank management, right? So when the bank's doing this kind of business, intermediary business, how do they manage the bank's performance? So the banks are to be managed, or banks are to be managed in perfect way, because they are running their business based on or using depositors' money, right? So it's very critical. They have to have very good management concept in their banks implemented. So board of directors and other supporting items should be in place, so then they can manage a bank very well. Otherwise, like, general public, if the bank make losses, so general public is going to be affected, so that will have a huge impact on the economy. Not like other entities. If a bank fails, that will be a contagion effect in other sectors as well, and overall economy as well. So we should be very mindful about the management of banks. So I want to discuss few areas, critical areas, right, in bank management. So if you look into that in detail, there are few areas the bank management in a specialized way, right? One is liquidity management, other one is asset management, other one is liability management, and then capital adequacy management, credit risk, and interest rate risk. So maybe basically risk management, right, covering credit risk and interest rate risk. So these are the areas I would like to discuss in a brief, right? So first, when you say liquidity management, the acquisition of liquid assets that are liquid enough, right? Acquisition of assets that are liquid enough, right? And then asset management, acquiring assets with a low risk of default. Or liability management, acquisition of funds at low cost, and other items, right? Okay, we will look into that in detail. First, I am going to look at liquidity management and the role of reserves, right? Now, you know, like, banking business is solely based on the financial assets and liabilities. So you are going to deal with financial assets and liabilities. So in this sense, the one of the key risk is liquidity risk. What do you mean by liquidity risk? A bank should be able to pay its liabilities as and when it requires, right? So whenever liability is due, then bank should be able to pay off, right? If a bank failed to pay off that liability, what will happen? So that creates the liquidity risk, right? So then that will lead to a bankruptcy, right? A bank may collapse if they cannot manage their liquidity properly, right? Because now you think like, actually, like banks businesses are based on reputation, right? Why everybody is keeping money with the bank? Because there's a trust, right? The people can trust these banks, and without asking any question, without doing any proper analysis, or like whatever the reasons, they just go and park their money in the bank because already the trust is built up, right? In that case, if you see a bank refuse to pay back their liabilities on time, that story goes around the market immediately. So what will happen? So all the people or all the depositors will come to your bank and ask their money. If everybody comes together and asks their deposit to be repaid to them, so then bank cannot afford to that, because as we discussed, it's already assets are transformed, right? That means they get a short term but like liabilities, and then they lend loans that is long term. So if everybody comes and asks their money, you may not be able to pay them. That is the liquidity risk. So you should manage properly, right? So if something missed around, and if you are unable to pay back their like liabilities or their money, so then definitely the bank is going to be in trouble. That's why liquidity management is key in a bank compared to other companies, because like banks are dealing with financial assets, right? So they should be able to give the money back as soon as possible, or like on due, right? Or when the customer asks, right? Now if you take a current account, so whenever the customer asks, you have to pay back. Or even saving account nowadays, right? So you should be able to pay back, right? So banks should manage their liquidity properly. So let's see a liquidity management and the role of reserve, right? What will happen, right? Okay, now say first uh, scenario, like excess reserves, right? What will happen if you have excess reserve? See first the liabilities. You have a deposits of 100 million, and then bank capital is $10 million, so you have altogether $110 million. The asset size, right? You can see reserves $20 million, loans $80 million, and the investment on securities, that's a $10 million. So altogether $110 million. So source of funds are deposits and capital, and use of funds are reserves, loans, and securities. The balance sheet size is now $110 million, right? So now suppose okay, as we discussed, like the reserve requirement is 10%, right? That means like if you have a 100 million deposit, you should have only 10 million reserve. But here what is happening? You have 20 million reserve. That means you have excess reserve. Clear? Fine. Now let's assume, right? A customer wants to withdraw a 10 million from your bank. So see the second balance sheet, right? So if a customer wants to withdraw $10 million, so then the deposit will go down by $10 million. And then reserve will be declined by 10 million, right? Okay, now you are settling through your reserve account. Now when you have the excess reserve, because you had excess reserves of 20 million, now after paying the 10 million even, now you have still reserve of 10 million. That means still you have sufficient reserve, because now the requirement for the reserve is 10% of the deposit, that is only 9 million, but you have still 10 million, so you are well off. So whenever you have if a bank has ample excess reserve, a deposit outflow does not necessitate change in the other parts of balance sheet, right? You see, nothing change, only changes happens on deposits and reserve, nothing on loan, nothing on securities when you have excess reserve. But the problem is when you have short, right? Shortfall. Now see the balance sheet, first one. You have liabilities of 100, that means deposits of $100 million. So you have to maintain 10% of the deposits, so that means 10 million you are maintaining. Now you have loan of 90 million and securities of 10 million. So your balance sheet size is 110 million now in this scenario. So assets, total assets is 110 million and total liabilities are 110 million. Now the problems, let's take the same scenario. Now a customer withdraws 10 million, right? What will happen? The deposit will go down by $10 million. Same time, now you had reserves 10 million, now you paid through the reserve, now the reserve is 0, right? Now keeping a statutory reserve SRR, we discussed, it's a legal requirement, statutory requirement. That's what they say, statutory reserve requirement, right? So now you below the requirement, now you are in a trouble, right? Reserves are a legal requirement and shortfall must be eliminated. You cannot have shortfalls, right? Excess reserves are insurance against the cost associated with deposit outflow. Now the problem is, now you cannot have a reserve below 10%, so you have to find the money immediately. So now when you try to get money immediately, you have to pay high cost, because you have to borrow from the market, right? Or you have to do something else to fulfill this requirement. So that's what we always say, the excess reserves are insurance against the cost associated with the deposits outflow, right? Because like if you have excess reserve, you don't have that shock, right? Okay, now let's assume now you are in short, right? Now you are in short. How much short? $9 million shorts, because your deposits is 90 million. Now the 10% is 9 million. So how can you refill immediately? Because it's a legal requirement, so definitely you have to do something. So what you can do is you can borrow, right? If you can borrow 9 million immediately, now your borrowing increased by 9 million and your reserve increased by 9 million. So now, okay, you satisfy with the legal requirement, but only thing is cost incurred is the interest rate paid on the borrowed funds. So you have to pay interest, right? if the market knows that you are short of fund, definitely they are going to lend you at a higher rate, right? So then the cost you have to incur. So this is the liquidity management. If you don't manage your reserves or liquidity properly, you should be like paying more, right? Your cost would be very more, right? Or like without borrowing, you can sell your securities, because you see in your balance sheet earlier you have securities of 10 million, right? Now you can't, okay, you there may be two scenarios. You don't want to borrow, or you cannot borrow from the market. Maybe cost is so high or nobody is lending to you. So then what you have to do, you have to sell your investment or securities. So you had 10 million securities, now you can sell 9 million, right? If you sell this, because like 9 million securities, 9 million worth of securities at the like the value which is booked in your balance sheet, okay, you will get $9 million. But the problem is sometimes when you are trying to sell, that can be discounted, or like their value can be less than the book value, right? That we cannot assure. And same time, of course, if it is a trading portfolio and mark to market, so then value may be similar, but there can be small deviations. Okay. In addition, the cost of selling securities, the brokerage and other transaction cost. Even though you try to sell, there's a cost. You have to pay for brokerage and other transaction cost. So you can sell securities 9 million and you can get into that amount to reserve. Now you can see 9 million worth of securities. Now balance sheet changes. The asset side, you can see the securities decreased by $9 million and reserve increased by $9 million, right? Now you can cover the reserve requirement, but only thing is still you have to incur cost, right? What is the cost? Maybe one is brokerage, another one is other transaction cost, right? Okay, so we saw like if there's a shortfall, you can borrow or you can sell your securities to refill your reserve, right? Okay, and then if you don't have sufficient fund, even you can borrow from Federal Reserve, you can borrow from Fed, or you can borrow from central bank, right? Okay, now if you borrow from central bank, your liability also increases by $9 million. That is like new item called borrow from Fed, 9 million, and same times your reserve increased by 9 billion. What is the difference? So nothing. You can borrow from outside or you can borrow from central bank, but only thing is you have to incur interest rate, interest cost, right? You have to pay interest. So interest rate may be vary, right? Borrowing from central bank and borrowing from other banks, the interest rate may be vary, but still you have to pay interest payment. And also the Fed or central bank can determine the discount rate as well, right? So that may be different from the borrowing from others, but still finally you have to pay a cost for that, right? So now this is borrowing from Federal Reserve, right? Fed. Or like finally, like you can think of, okay, you can recover the loans 9, or you can recall early, right? So 9 million worth, and you can add to the reserves, right? That also one of the way you can fulfill the reserve requirement. So that is reducing loans. So reduction of loan is the most costly way of acquiring reserve, because like once if you have given loans, you cannot recover those before the due date, right? And even though like if you have the due dates, it's sometimes the borrower may not be able to pay back. So so even though you, when you call like early, then calling in loans antagonize customers, and other banks may only agree to purchase loans at a substantial discount. Even like you can have kind of some secure some arrangement with other banks. That means selling your loan portfolio to other banks by way of securitization or something like that. So but still, so other banks will have a substantial discount on your loan portfolio. So you can get by selling your loan portfolio this $9 million, but that also will come with a huge cost compared with other avenues, right? So now you have to think of, so then liquidity management is very key, because if you don't manage properly, you are going to lose money. So excess reserves are insurance against the cost associated with deposits outflow. The higher the cost associated with deposit outflow, the more excess reserves a bank will want to hold. This is the ultimate trade-off. Now, if you can, if you can borrow from the market at very lower rate, so very lower rate, so then you don't need to worry. You can have minimum reserves, right? Because you know, like even though the deposits going out, you can quickly borrow from the market and set off, right? But if you think no, the cost like cost of this borrowing may be very high, and you may not be able to borrow at the required time and the required quantity, so then you have to maintain excess reserves. So it's excess reserve, as we discussed, always act as an insurance against this cost, right? So you have to evaluate both sides and come to a equilibrium level or trade-off. What is the level of reserve we are going to maintain over and above the legal requirement? So legal requirement is very that is the minimum, so you can't go below that, but how much you can maintain above that is based on your cost of borrowing to set off this reserve outflow. Okay, so now the first we saw liquidity management. Second, what we are going to discuss is asset management, right? Banks, as an intermediary, they should be able to manage their assets, because like the assets are the items going to bring the revenue to any entity. So banks per se, like assets going to bring revenue for them. So if they want to maximize the profit, if the bank want to maximize its profit, then definitely they have to manage their asset properly, efficiently, and prudently, right? So the three important areas they have to consider when they manage their assets. One is seek the highest possible return on loans and securities. So the key assets are, one is loans, other one is investment securities. So the bank should look into that possible higher return, right? Higher return as much as possible. But they also should keep in mind uh, the the formula, the basics of finance. That means the higher the return, higher the risk. The lower the return, maybe the lower the risk. right? So if you go for a higher return, definitely the risk attached to that investment is higher. That's when you are going to get higher return, right? So you have to maintain the risk and return profile also. So simultaneously they have to think of like return and risk. So while they are seeking the highest possible return, they have to think about reducing the risk as well. That is the key in asset management. And third, they have to think about adequate liquidity also. Now that's also a trade-off, right, when you manage the assets. Now when you have more liquid assets, you will have less return, because you think about like you have all your like source of funds in a cash, 100% liquid assets, but can cash earn anything? No, your return is nil. So you cannot have all your assets into highly liquid cash. So you have to lend, you have to invest. So when you invest, you are going to lose your liquidity, but you are going to earn. So now you have to decide, the bank should decide how much to lend and how much to keep as cash. So this is where you have to think about the trade-off as well. So trade-off are in several ways: risk versus return, right? Liquidity versus return. So you have to think of, right? So asset management, any bank should think of these three areas, critically analyze and take the decisions. Okay, so how they can overcome this one, right? Especially under asset management. So banks should find borrowers who will pay high interest rates and have low probability or possibility of defaulting. So banks should now lend its customers or public. It should be able to lend at a higher rate, but same times the low possibility of defaulting. So that means the customer credit worthiness should be very high. At the same time, you should be able to get high interest rate. Normally what happens, like this also, like risk versus return. So people who are having uh, like more possibility of defaulting, they will agree to pay high interest rate. But people who are having like very less probability of defaulting, they will agree to pay only low interest rate. So then if the banks want to have high interest rate, so you have to go to like subprime customers, not prime customers. Prime customers, they are not going to pay high interest rate because they know they are highly credit worthy and they can get low interest rate loans. So the bank's challenge is like getting high interest rate from a prime customers or highly credit worthy customers. That's one thing, right? And a second thing, so this is the way like banks are specialized in, right? Because they know where to get a high interest rate, so to whom they can lend with a low risk. So they know, they are expert in this, right? Okay, so the next one, purchase securities with high returns and low risk. This is similar, right? So they have to find securities, the bank should find securities with high return, same times low risk. It's not a simple thing, right? So we know like basic, right? If you have high return, definitely the risk will be high, right? If the risk, the low return, then maybe risk may be low. Like like think about an example like treasury bills, right? So treasury bills, right? The bank can invest on treasury bills, but the problem is, right? It's a low risk instrument, because like anyway you don't see any default, right? Government will pay back, but only thing is you don't get high return because treasury bill rates are even, basically low. But if you are going to lend to a customer, yes, of course, you will have more, like 4 or 5% more than a treasury bill rate from a customer. But only thing is, so their credit worthiness is, poor compared to a government, right? So then, but still, the bank should go around and see the which securities are giving high return with low risk. So they have to purchase them, right? So not only within the country even, but also outside the country they can think of, right? And third, when you see like asset management, the banks can reduce their risk by diversifying. That's a key strategy, right? So diversification, right, to reduce the risk. Now, in a finance, in a layman language, right, people say don't put all your eggs in a single basket, right? So if something happened to the basket, you will lose all your eggs. So that's what, like, though in a finance, in theoretically, when we speak theoretically, like you have to keep in several baskets. So once something happened to one basket, you will get others are safe, right? So in a business also, we usually in our high school we study, right? So if you have a ice cream shop, right, there'll be huge business during the summertime, and you don't get any business during winter time. So you have to 6 months you have to have very good business, and next 6 months you will have a very low business. So like, and in a finance perspective, you can, if you can have both business, that means ice cream business, hold on. Okay, now you can see, like, if you can have both business together, like that means you can have ice cream business as well as you can have raincoat or jacket business. So then one may be yielding in summertime very well, and other may be yielding, or jacket business or umbrella business or whatever it is, like yielding um, very good business during winter time. So this is called diversification. Rather than relying on one asset, one type of assets, you can rely on various assets, right? So when it comes to diversification, for an example, in banking business, like let's assume a bank lending its all loans and advances to agriculture sector. So what will happen in a drought time? So agriculture will be performing very badly. So all the loans might be falling into non-performing loans. That means like loans which are very difficult to recover, and the borrowers, they won't pay their installments. So banks will not get capital or interest from that lending. So, but if a bank can diversify its business or lending to to various sectors. So 10% to agriculture and 10% to SME and 10% to manufacturing sector or various things. So then what will happen? So then if one goes wrong for a short time, others will be performing very well. So bank can manage its profitability and performance at very good level. So the banks can reduce their risk by diversifying their assets. So this is one of the key in asset management. And fourth, the balance need for liquidity against increased return from less liquid assets. Okay, so when it comes to asset management, so banks also should consider balance need for liquidity, right? So as I explained earlier, so they have to think about how much liquid assets they have to have and how much um, illiquid assets or less liquid assets they have to increase their return. So they have to think of both and decide finally what is the mix they have to have, right? So this is asset management. So now we have seen how banks can manage liquidity and how banks can manage assets. And liability management, right? Now like that, nowadays the liability management also one of the key areas. Actually nowadays we don't call it separately assets management, liability management. We call it assets and liability management, ALM functions, right? You should be able to understand what is ALM function. So that means how to manage assets and liabilities, right? That is ALM function. So there are dedicated officers in the banks or unit in the bank. They always trying to see the avenues where they can get a proper management uh, in assets and liability of a bank. So liability management those days at the beginning, it was not that serious, um, because like one thing is like most of the banks they were having checkable deposits. It's in the first US banking system scenario. So they have like more than 60% checkable deposits those days, or maybe before 5 decades or six decades, something like that. So what happens, that checkable deposits, that means current account, there's no interest, there's no cost. So you don't need to manage that much, or you don't need to give your effort to manage that much, because it's always we are having free fund, right? But after sometimes it started to change, and larger banks, there may be larger banks, they are giving call money. You can see they used to get into call money lending, so they call it call money center banks. So they started to charge interest, and then negotiable CDs also coming into play. So deposits were like the deposit mix moving towards no cost deposits to like costly deposits. So now the bank started to manage their liability as well, right? So when it comes to like, okay, now the checkable deposits are very less, and you have to pay for deposits, and you have to pay for borrowings, and you have to pay for the investors, that means um, capital holders, right, shareholders, then definitely the liability you have to manage, because now it's both sides. You have to increase the income through assets management, and you have to reduce the cost through liability management to have a better performance. So if you want to increase your profit, you have to increase your revenue, same time you have to increase your cost. So now its ALM function is one of the key area in the banking business. Now, as we discussed in the liquidity management, right? Now, one of the major functions is capital adequacy management. So banks should be ensured. So banks are required to ensure they have adequate capital. They have to manage their capital properly. Then only they can have a sound banks, right? What is mean by capital? So we always say it's a shareholders funds. Why do we need shareholders funds? Because the capital is the only one that's a cushion that absorb possible losses. Right now, you can recall the balance sheet of a bank. The liability side, you can see deposits, borrowings, and then capital. Now, you think like something happens to the bank's performance and there's a huge loss, right? How you can absorb the losses? In a normal trading company, the capital is 60%, 70%, right? Of course they can absorb through capital, but in your bank can run with depositors money. So shareholders, they wanted to have minimum capital and run the bank, but something happened, goes wrong, and there's a huge loss, right? If you have a small capital, right? So the capital would be eroded easily, quickly, and then it will be a depositor's money. So banks are always required to maintain capital, adequate capital. So if you can have adequate capital, the bank can absorb any losses and prevent bank failure. Right? If you can't absorb losses through capital, definitely public is going to lose their money. That means a bank failed. Sorry. So a situation in which a bank cannot satisfy its obligation to pay depositors and go out of business, right? If any bank say, right, they cannot pay to their depositors, that means the bank in trouble. That means that will lead to a bank failure, bankruptcy, right? So the amount of capital affects return for the owners of the bank, right? So in other hand, if you have excess capital, that's a cost to the bank and cost to the owners as well. That will affect the owner's return as well. So you should have a trade-off on that as well. Now you have to think about both sides. You can ask, okay, you should have capital, sufficient capital. Same time, if you request bank to have excess capital, then owners are going to be demotivated because their return will be lower. That's what, to avoid this one, so there are conflict of interest. So owners try to invest less capital, but in an economic perspective, so you should have a sufficient capital to absorb the losses. So there will be always a regulatory requirement to have minimum capital. That is the capital adequacy, right? Okay. Okay, you just think about, as I explained, how bank capital helps prevent bank failure, right? Now there are two banks. One is with high capital, other one is with low capital. Okay, you can call it high capital bank and low capital bank. See the balance sheet, first table, and for high capital bank, asset size, you have 10 million reserves and 90 million loans. Liability sides, you have 90 million deposits and capital 10 million. So your balance sheet size is 100 million, right? So look at the second table. the high capital bank, right? Now you make the losses. That means you have given loans, right? You have given loans, and out of this 90 million loans, right, you were unable to recover 5 million loans, so you are making loss, so you are going to provide for that, right? It's a defaulted loan, so $5 million defaulted loan. So until happens, your balance is going to change now. Reserve, of course, 10 million, nothing changed, but your loans now become 85 million from 90 million. So that is when you make the provision, loan loss provision. So that is the loss to the bank. You are absorbing that loss through your capital. That means you have the 90 million deposit, same deposits, but now your capital is 5 million. So now your balance sheet size is $95 million. Earlier we had $100 million balance sheet. Now we have $95 million balance sheet. Why that happens? Because of the default. So your loan become $85 million and your capital became 5 million now. So even though you had $5 million loss, you absorb easily because you had high capital. That means 10 million capital. But think of low capital bank. Asset size, asset side, you can see reserves 10 million and loans 90 million, but liability side, you can see deposits 96 million and bank capital is only 4 million, right? How much bank capital? That's only 4 million. So then take the same example, right? So the loan, the 5 million worth of loans became bad. Now you are going to make provision, loan loss provision. So then your loans decline to $85 million. Similarly, your capital is going to be declined by $5 million. Now your capital is negative, that is negative $1 million. So now net worth is a negative net worth. So now how can you absorb this 1 million? Negative. Only you had 4 million capital. So now you have to fund this 1 million through whatever the ways. Now you have to pay these losses through depositors money if you don't have additional capital. So if you're going to lose depositors money, it's almost a bank failure, right? So net worth of your bank is negative. That means any dues you should be any loss you should be absorbed through depositors money, right? So this is called bank failure, right? Okay. Now the capital adequacy management. So you also, one side you should be able to have minimum capital, right? Another hand, you should be able to have sufficient return for the capital as well, right? Hold on. Okay, so then I just want to elaborate how to measure the returns to equity, right? You might have seen return on assets, return on equities in other companies. Similarly, in banks also you can assess. So the return on assets, that means ROA, that means net profit after taxes per dollar of assets. The formula is like if you want to calculate ROA, net profit, you take the net profit after tax and divide by your assets, total assets, right? Similarly, return on equity, net profit after tax per dollar of equity capital, that means ROE equal net profit after tax divided by equity capital, right? So you also can see the relationship between ROE and ROE, that is equity multiplier, right? The relationship could be explained by equity multiplier. What do you mean by equity multiplier? The amount of assets per dollar of equity capital. That means assets divided by equity capital, right? So you can see the relationship. The ROE is equal ROA multiplied by equity multiplier, right? It's simple. It's nothing to think so much, right? So this is to assess the return on assets or return on equity. That means overall performance of the bank, right? If somebody wants to assess the overall performance of the bank, right, the very first evaluation criteria is ROA, ROE, right? So this shows you how do you manage your capital effectively, right? If you can manage your capital efficiently and effectively, so then your ROE and ROA would be better than other peers or other banks. Okay, so finally, when you see about capital adequacy management, as I said earlier, the trade-off between safety and return to equity holders. You have to think of both sides. Safety, if you want to have more safe bank, you have to have more capital. But if you think about return to equity holders, you should have less capital. So which are like which one is very important? To have more safety or better return to equity holder? You should have both. Because if you think of more safety, safety is better. If you think of more safety, right, nobody will come and invest to the bank because they will think if you ask more and more capital, they don't get more return, right? So there should be a trade-off that should be beneficial for both safety and return. Benefit the owners of the bank by making their investment safe, right? So bank safe means so investors investment also safe. We have to think that as well. The costly to owners of the bank because the higher the bank capital, the lower the return on equity, right? Okay, and choice depends on the state of the economy and level of confidence. Now, if the economy is performing very well and the level of confidence on the banking sector is very high, you can have low capital. That's a final point. Now, if you take economy like US economy, a very strong economy, right? So they can have very low capital requirement. Or OECD countries economy, so they are very strong, fundamentally very strong. So they can ask only 4%, right? So 4% capital requirement. That means for simple sake of explanation, you take the total assets of a bank that should be risk weighted anyway, right? Or keep in mind, or you can read further, you take risk weighted assets and the regulator can say they have to have capital at least 4% of the risk-weighted assets in a simple manner. So, but if a economy is very weakened, and then level of confidence of the economy of bank sector is very low, so then the regulator can ask more. If it is 4, so in OECD country banks, so then this can be a 6 or 8% or whatever it is. So it's based on the economy and the state of the economy and the level of confidence. So like you should have trade-off, and how to arrive that trade-off is depends on the state of the economy and level of confidence, right? Okay, so this is capital risk management. So it's a big deal for banks manage their capital as well, right? Okay, so we have seen capital adequacy management, and then managing credit risk. Now you should think sorry, the credit risk is the key element in overall risk management, because you can see, as we discussed, like more than 60-70% of the total assets are loans and advances of banks. Okay, so you can think of total the loans and advances are the key component of a bank balance sheet. So that means there will be a huge credit risk attached to the bank business. What do you mean by credit risk, right? If the borrower, the possibility of a borrower to default the installments or repayment of the loans and advances, that is credit risk, right? So if the borrower failed to pay their repayment as and when due, banks exposed to credit risk. As these 60%, more than 60% of the assets are into loans and advances, the bank is going to have huge risk, especially on credit, right? As we discussed earlier, the major risk coming from in two fronts, that is adverse selection and moral hazard in loan market. We discussed that in our very first or second discussion, right? When you say, like I just repeat, right? When you say adverse selections, so if bank makes things wrong in selecting customer, so that means this is before granting the loan. There can be a mistakes in selecting customers. You can lend or bad credit worthy customer, that is adverse selection. And moral hazard, that's after the loan granted. That means the person you believe, okay, he is good and we can give the loan, and you chosen him and given the loan, but he did and different thing. He make use of the loan for some other purpose, maybe very risky activities. So then there's moral hazard, right? So banks can avoid this credit risk through very good screening and monitoring, because banks are specialized on screening and monitoring, right? That's the one thing. So they should be able to manage this adverse selection and hazard, moral hazard problem through screening and monitoring. So screening at the beginning, then continuous monitoring after granting loan, right? When you say screening, you're screening the customer, right? All with available data, you screen him and see whether he's credit worthy, right? So specialization in lending, so the banks are very specialized, so they know each and every different kinds of lending, so they can do accordingly. And monitoring and enforcement of restrictive covenants, so they can, like, banks can monitor each and every customer, and the banks can enforce, right, covenants. Okay, you have to have maintained this level of profit, you have to have maintained cash flow like this, so many requirements bank can enforce, and you can, like, bank can continuously monitor to minimize the credit risk. um, you always remember banks business is risk taking. You can't eliminate risk taking, but you can minimize risk taking. In addition to screening and monitoring, so banks can maintain long-term customer relationship. So then they know customers' activities in and out for a long period. So they can avoid credit risk. And through loan commitments, so that means, like, they can say, okay, there's a loan, right? We have approved, so you can use it. Okay, after some requirements satisfied by the customer, so it's a loan commitment. So maybe like overdraft, like they have given overdraft, right? They can use 50%, and like in later time they can use 100%, or like they grant loans, maybe as an example 10 million, and they can only disperse 2 million now, and later you can disperse balance. So it's a loan commitment, so the customer also will be willing to maintain the relationship, so credit risk could be minimized. And other way, like collaterals and compensating balances, right? In Sri Lankan banking sector, like, always the majority of the loans are backed by collaterals, right? um, Not maybe the prime customers one, but still the collaterals are important item in Sri Lankan bank sector. If you take developed countries, they give the loans based on the cash flows, the business itself, maybe not relying on collateral that much, because they consider cash flows that business generating, maybe the base for their business. But here, like, in addition to those cash flows analysis, the Sri Lankan banks rely on collateral. If customer fails to set off or settle the loans, so bank can take out the collaterals and sell and settle the loans. So that is one of the item or technique used to avoid credit risk. And compensating balances, so, like, there can be a lot of requirements when the banks gives loans, and banks can say, of course, okay, we are giving loans, right? You can utilize this loan for your business, but same time you have to maintain a balance in your current account, at least minimum 1 million balance in your current account, right? So that is compensating balances, kind of. So through this kind of requirements, the bank can manage the credit risk. And finally, the credit rationing, right? The credit rationing, so banks can decide, okay, how much they are going to fund for project A, and how much they are going to fund for project B. Through that, right, they can minimize their credit risk. Okay, so then we have seen the managing credit risk. So you can now, I just want to recap the previous discussion as well. So banks, as I said, always, like, banks are like intermediaries dealing with deficit unit and surplus unit. um, they they support the fund flow. That means they are earning return by supporting fund flow, right, through intermediate job. So they are then risk takers, right, in the sense they always should face risk. They are exposed to risk, right? So you can't eliminate the risk. So the major risk in a banking business is credit risk, market risk, liquidity risk, right? Operational risk, reputation risk, legal risk, so many risks, right? So out of that, the key risk factors are credit risk, market risk, liquidity risk, and operation risk, right? So and technological risk mostly you can cover, and operation risk as well. So now we have seen early, right, initially the liquidity management, that means the liquid risk we are going to manage. And now we have done credit risk, how to manage credit risk. Next we are going to talk about um, market risk management. So when you say market risk management, the possible losses arising from the movements in the market, right? So market, when the movements happens in the market, your ability to earn revenue, or your the value of the assets and liabilities changes. Through that you can have possible impact or negative. That means you can have profit or you can have loss. There is a market risk. So under this market risk, there can be interest rate risk, there can be exchange rate risk, there can be price risk, right? These three are very important, right? So what I want to say is, when the interest rate changes in the market, the bank can benefit or lose. When the exchange rate changes in the market, so bank can benefit or make loss. When the price changes in the market, price, when I say price, that can be share price, there can be commodity price. Now assume like the bank invested on a gold. So then when the price changes, the gold price changes, you will have a benefit or sometimes hit, right? So these three are very important. So first I'm going to talk about managing interest rate risk. So interest rate risk is a key in um, banking business, because like their revenues based on the interest, right? Interest income is the biggest income in banking business. But you have to think of one thing, the interest also, bank can have fixed interest rate or floating interest rate. Let's see this example. First National Bank. You could see assets and liabilities in this balance sheet. If you take the asset sides, right, I have mentioned rate sensitive assets, that can be variable rate and short-term loan, short-term securities, whatever it is, that is worth of 20 million. And fixed rate assets, you have 80 million reserves, long-term loans, long-term securities. So when you enter into long-term loans and long-term securities, so you are not going to change the interest rate. That's a fixed for long, right? But if it is a like rate sensitive asset, so it can be very short-term loans or short-term securities, or like floating rate loans. So every 6 months it may be changed. You have to understand one thing: if the fixed rate, even though the market rate changes, you don't get anything. Nothing will change in your revenue or balance sheet. But if it is a floating rate, what will happen? When the market rate goes down, your interest rate will go down. So your assets earlier maybe 10%, let's assume. So that means 10 rupee earn assets. Now the interest rate is 5%. So you are going to earn only 5 rupees. So you are going to lose 5 rupees because of the interest rate changes, right? So this is also asset side. And let's assume this liability side, right? So liability side also you can think of fixed rate liabilities and rate sensitive liabilities. If the deposits are variable rates, then that's a rate sensitive liability. But if it's a fixed deposit, serving deposits, or others fixed rates, so that also will be affected, right? If they, when the interest rate increases, if it is a floating rate liability, you are going to pay more now. Your interest cost will go up, or if the interest rate is coming down, will come down. So now that is income perspective, right, or earning perspective. And value also you can remember, like we discussed under interest rate analysis, when the interest rate changes, what will happen to the value of the portfolio, value of a security, right? So when the interest rate increases, your value of the security will come down, so you're going to lose. So that is, we call it economic perspective, right? Earning perspective and economic perspective. So now this also the bank should be able to manage. That's managing interest rate risk. It's a huge task. There's a like kind of technique most of the banks use, that is basic gap analysis. You put into different so maturity buckets. So that's approach is maturity bucket approach. So you can put all your assets and liabilities into different maturities. That means 0 to 7 days, 7 to 31 days, then 1 month to 6 months, like that. You just go through an annual report, as I said earlier, right? You go through a bank annual report. These are there, right? How they manage interest rate, what is their capital adequacy, right? How do they manage credit risk, exchange rate risk, so everything. So there can be some chapters explaining this integrated risk management framework. So here, the maturity bucket you can prepare, put into different buckets, and see the bottom line is a gap. And if you take gap, or maybe as if the assets more than the liability, that's a positive gap, and if the asset is less than liability, that's a negative gap. And you take the gap and multiply by a assume interest rate change, maybe 1% change or 2% change, and calculate and see what will be the impact on the bank profit. And it's a very simple, you can straightforward, you can see and understand, right? Okay, so this how the banks manage interest rate risk. Okay, up to now we have discussed the bank's intermediary functions and how they manage a bank business, and what are the risks and the importance and its explanation, right? So next, what we are going to discuss is regulatory framework. So overview of the Banking Act and the directions. Now next, I'm going to discuss about the regulatory framework, right? Like bank regulations. So here, what I'm going to discuss is Sri Lankan regulatory framework, that is basically Banking Act, right? So I will discuss the Banking Act, its features and the requirements after the break. So 15 minutes break. So we will start again at 3:15. Okay. Okay, we can start now. As I said, this would be the last chapter for me, and exams will be covered out of these areas. That means interest rate analysis, exchange rate analysis, monetary policy, and then financial intermediation and regulation, right? So if you can have a thorough knowledge on this area as we discussed, that's sufficient, right? And further reading is encouraged, right? So now we are moving into regulatory framework, right? Under the regulatory framework, right, especially we are going to look at Banking Act, right? So like you can, there are two major regulations. One is Monetary Law Act and then Banking Act. In addition to that, there are other regulations as well. So Payment and Settlement Act, like that. So I encourage you all to go to Central Bank of Sri Lanka website, right? You can have so many regulations, right? At least to get some idea. You don't need to read all these regulations and all. To get some ideas for your knowledge for your future work, maybe, right? You can refer whenever you need some support or help. Also, you can read those for exam purpose, right? Mainly, it's a Banking Act, right? So let's move on to this area. Okay, first, the regulator's role. As we discussed earlier, the central bank is the authority responsible for administration, supervision, and regulation of the monetary, financial, and payments system of Sri Lanka, right? So the Central Bank of Sri Lanka, right, especially supervise and regulate monetary system, financial system, and payment system. The three key areas. These three key areas are specially supervised and regulated by Central Bank of Sri Lanka. So when it comes to financial system, you can see the Central Bank of Sri Lanka has core objectives, right? One is economic and price stability. Other one is the financial system stability. All over the world, central banks, the key objective of all these central banks are price stability. But some of the central banks, in addition to this price stability, they also responsible for financial system stability under their law, right? But some of the countries, you can see there's a separate entity to look after financial system stability, right? But in Sri Lanka, central bank has a dual role. One is price stability. At the same time, they have to maintain financial system stability. You can go through the website and you can read what are the objectives of central bank, functions, and all these things are listed there in a brief. So it's very important to read those. Why are regulations important? That's very important questions, and I discuss slightly like that. Why these regulations are important? Because regulations are the first line of defense, right? If you want to safeguard something, you have to have um, defense line, separate defense line. So the regulations are the first line of defense because that give you a framework. That gives you a framework. Within that framework, you have to run your business, right? So maintain, as I said, to maintain the financial system stability, how a bank should operate. So that is given by a framework. That is the regulatory framework. So that's the first line of defense. So there may be a second line of defense, third line of defense. These are to ensure these banks are within their frameworks and having their oversight also in place sufficiently. Okay, why these banks are very, very important? Why we need right, very, very complex regulations on banks? Why always the banks are exposed to regulations compared to other companies or other business entities or within even financial system? The banks are monitored, very closely. Why? Because now, as I said, what is the objective of central bank? To safeguard the financial system stability, so maintain the financial system stability. So to maintain the financial system stability, the central bank should look into all the players in financial sector, their stability, their operations, right? But if you take the financial system, the key players in the financial systems are banks. If you take the total assets of a financial system, more than 60% of the assets belongs to banks. So then, in a way, if you can have a strong banking system, you can have some extent a strong financial system. One thing. And if you have a problem with banks, definitely that is going to affect the whole financial system because the majority of the assets are with banking system. So that's what the regulations are so important for banks. That's one thing. And second thing, as I said earlier as well, banks are highly leveraged institutions. So you can take, as I said earlier, like you can take a normal trading company and see their capital is 60-70% of their liability, total liabilities, the 60-70% of the total liabilities are funded by capital. But if you take a banking system or bank, even I saw what is happening in US, right? 11%. So then it's highly leveraged. So capital to external liability, it's highly leveraged institution. If something goes wrong, that immediately lead to bank failure, then that will have a very much a bad impact on the financial system stability. Then in turn, that will affect the economic system. That is second. And then third important factor is the nature of the banking business. As I said earlier, banking businesses, right, is taking risk. Not like any other business, banking risk is like banking businesses taking risk. So it's unavoidable. So because of that, regulations are so important, right? Okay. I have quoted here like the statement made by Alan Greenspan. Alan Greenspan is the president. He was the president of Federal Reserve Board. Board Federal Reserve Board in May 1996. He has given this quote, right? You just remember this, right? This is the key, right? We should not forget what is stated is like we should not forget that the basic economic function of these regulated entities is to take risk, right? Nobody can forget that this bank basic function is to take risk. If we minimize risk taking in order to reduce failure, right? Or if we minimize risk taking in order to reduce failure rates to zero, if somebody think, okay, we minimize the risk, so then we can brought down the failure rate to zero. That means we will by definition have eliminated the purpose of the banking system, right? It's a clear statement. So you cannot try to minimize, right, risk take in order to reduce the failure rates to zero. So failures happens, right, because you can't eliminate, you try to minimize. It doesn't mean like you bring down to zero, right? You try to minimize if that is excessive risk taking, okay, but that is their job. So behind this statement there can be a lot of interpretation you can have. So then you cannot reduce the failure rates to zero, so there can be bank failures, right? There can be finance company failure, yes, of course, because you cannot reduce that, you cannot eliminate that, because their business is to take risk. If you try to bring everything to zero, then you are eliminating the purpose of the banking system. That's what he said, right? So keep it in mind, right? So then anybody blames central bank, anybody blames regulators, saying, okay, there's a failure, this a failure. Yes, of course, that happens. That's a business, right? Okay. Now I'm going to look at the Banking Act. First, I give you a list of salient features in Banking Act. Then we will discuss one by one in a brief. What you have to know is, okay, so Banking Act talk about so many things. And based on the Banking Act, there are directions explaining in detail and required banks certain aspect. Okay, this how it should be done, because Bank Act everything is very brief. So based on that, the monetary board is power to issue directions, so explaining what does that mean and what are the definitions, okay, what are the requirements under this sections. So that will be explanatory or new requirements. So you can download and see Banking Act is there, and all these directions are uploaded into the website, so you can see. If you don't understand, even you can go and read it. If you have banking experience, of course you can easily understand, right? Nothing rocket science there. Okay, so let's see. Under the Banking Act, the Banking Act talked about licensing of a bank, right? First thing. Second, payment of license fee. Third, approval of the monetary board to carry out certain transactions, businesses. Then fourth, complaints of persons and banks suspected of carrying on banking businesses. Alteration of memorandum and articles. Right. Then restriction of the use of the word bank. Operating subsidiaries and associate companies. Maintenance of capital. Maintenance of liquidity. Payments of dividends. Offshore banking business. Preparation of annual reports. Appointment of an auditor. Disqualification for being appointed as a manager or secretary or CEO and senior management. Power of the director of bank supervision. Monetary board to give directions. Conditions for grant of a loan by way of accommodation. Abandoned property. So these are key elements actually required in the Banking Act. Okay, mentioned there are so many sections you can go through, and each and every section talk about every aspect. So here, like I have listed out some key areas, not all, some key areas, and I will be looking at out of this a few important areas, right? Okay. First, license, right? So under licensing in the Banking Act, no business of banking business shall be carried out except under the authority of a license issued by the Monetary Board with the approval of the minister. So nobody can start banking business unless the Monetary Board issued license with the approval of the minister. So if anybody wants to start a bank, they have to apply and get the approval of the approval of the minister and the license from Monetary Board. You know what is Monetary Board? It's the apex body, right? It's the governing body of Central Bank of Sri Lanka. We call it Monetary Board. If you take a bank, it's a director board. Like that, if you take a central bank, it's a Monetary Board, right? Central Bank is the name. Actually, like we in a common name, it's a monetary authority. We call it Central Bank of Sri Lanka here. In US, it's a Federal Reserve, right? Okay, so then you should be able to know these, understand the differences of names, then you can easily read any literatures. Similarly, for banks incorporated outside Sri Lanka, relevant requirements of the Companies Act must be fulfilled, right? If let's assume there can be a foreign bank, right? They can, if they wanted to start a bank in Sri Lanka, right? There are requirements for a foreign company, right? And the Companies Act, they have to fulfill that as well. And these entities should make the application to the Monetary Board with articles, right? So after evaluation, the Central Bank of Sri Lanka provide letter of provisional approval. Then if the entity is satisfied with all the conditions given under provisional approval, then license may be issued after evaluation. That's a licensing procedure, right? So license for banking business. So license issued shall specify whether it authorizes the company to carry on domestic bank business or offshore banking business or both such businesses. You should understand, like there are two kinds of businesses. We call it DB, okay, domestic banking business or offshore banking business, right? Some banks, if a bank wants to do only domestic bank business, they can take the license only for that. Or offshore banking business, okay, separate license. Or some banks, if they want to do both bank banking business, then they have to get both license. The place or places of the area within which such bank business may be carried on, right? Okay, so then, right, the license will specify whether they can do DBU only, or domestic bank business only, or offshore bank business only, or both business. So license will specify. And similarly, the license also will tell you which area you can do the business, in which area, right? And in addition to that, the terms and conditions such to which such license is issued, right? So as I said, like there may be several conditions listed under license, so then they have to comply with those terms and conditions, right? So no licensed bank shall carry on businesses other than the business specified or carry on those specified in the Schedule 2 and 4 of the Banking Act. So Banking Act clearly says under Schedule 2 and 4 what are the businesses a bank can perform, right? Conduct, right? So so no banks or no licensed bank cannot do the business other than that specified in the Schedule 2 and 4 of the Banking Act, right? Now, if you want to like what are those business and all in detail, you can just go to Banking Act and just glance through, right? Okay. Okay, so in a brief manner, I just would like to say what is banking business. It's got it, right? Banking business means the business of receiving funds from the public through the acceptance of the money deposits payable upon demand by check, draft, order, or otherwise, right? So clearly it's clearly says how do you get fund, right? So acceptance of money deposits. So you are the banking business mean you accept deposits and use of such funds either in whole or in a part for advances, investment, or any other operation. So it's clearly say banking business mean, right, accept deposits and lend as loan and advances or investment, right? This is the bank business. So you should remember always, so without a license, nobody can accept deposits, right? No entity, no business can accept deposits without a banking license, because accepting deposits and lending, right, it's a banking business. If anybody wants to do this business, they have to get the license first. Now, this is the annual license fee, the latest one. The latest one says, right, if the assets are over 1,000 billion, you have to pay 33 million. If your assets is between 750 and 1,000 billion, you have to pay 32 million. Like that, every brackets you have to pay different amounts of license fee. And then if it is less than 25 billion, then you have to pay 3 million. So this is the license fee, right? Okay. So 2021, the banks are required to pay the license fee based on this bracket, right? Okay. And Banking Act also says the certain activities of the banks need monetary board approval, right? Okay, so what are those? As we look into the few items. For licensed banks to open, close, effect any change in the location within Sri Lanka. Okay, right? If a licensed bank, if they want to open, let's assume a branch if they want to open a branch, close a branch, or if they want to move a branch from one location to other location, they need to get monetary board approval in advance, right? To open, close, or effect any change in the location outside Sri Lanka, right? Definitely, if they are going to change like that, right? So if they take as an example branch, right? So it can be a branch, it can be ATM, right? It's a business, right? So then to open, close, or change in the location outside Sri Lanka, in Sri Lanka, within Sri Lanka, outside Sri Lanka, definitely they need a monetary board approval. If a bank wants to acquire the business of the licensed bank, yes, they need to get monetary board approval. Or like if any banks want to open a representative office in Sri Lanka, yes, they need to get a monetary board approval. And in addition, like merger or consolidation of a licensed bank. Now, if there are two banks, they want to merge together or consolidate, so they have to get the approval from monetary board. And not only these big things, even operate mobile banking units, they have to get the approval from monetary boards. You know what you mean by mobile banking? So mobile banking means now by vehicle, now banks can send their vehicles and taking deposits and lending. So for interior remote areas, yes, of course they can do it subject to monetary board approval, right? And next thing, acquiring a material interest, right? An individual, partnership, or corporate body shall not either directly or indirectly or through a nominee or acting in concert with any other party acquire a material interest in a licensed bank without the approval of the monetary board. Right? Now, this is a very important regulation, because now we know, like, a small portion is the capital in a banking business, maybe 10 to 15%. Right? So there are shareholders, few very strong shareholders. So they can control the bank, right? They can get all the shareholding, and they can appoint director board, and they can easily control the banks, and they can, get personal benefits out of that. Why? Because the bank is running its business based on the public deposits. So for their own beneficial, they can take the decisions. So to control that, the Banking Act says nobody can directly or indirectly or acting in concert can acquire a material interest. Right? So material interest means holding over 10% of the issued capital of a licensed bank carrying voting rights. So material interest means 10% issued capital. So nobody in the sense individual or partnership or corporate body, right? Nobody can have directly, not only directly, indirectly as well, or through nominee. Nobody can have material interest, because if you allow them to have material interest, they can make the decision. They can have the decision for their benefits, right? So finally, the bank will be affected and the economy itself, right? Here, there's a very, very critical wording: acting in concert. So it's very difficult to establish the people get together, and even not only one person. There may be 10 people get together, shareholders, 10 shareholders get together and can control the bank and take the decision for their favor, personal benefits. That's what it clearly says, each and every items, and one item is acting in concern. So to actively cooperate in acquiring a material interest in the licensed bank so as to obtain or consolidate control of the bank. So we should be able to establish whether these people are working together to control the bank. So the Banking Act clearly states everything together and avoid this acquiring material interest. Right? Very important regulations. And use of the word bank. Who can use the word bank in their name? Only licensed banks are permitted. But with the approval of the Monetary Board, use as a part of its name banks, banker, or banking, right? So only licensed bank are allowed to use bank, but with the Monetary Board approval, right? Some extent this is allowed, right? Restriction shall not be applicable to subsidiaries, right? If bank has a subsidiary, yes, of course they can comply with this. Other important aspect is investment in subsidiaries, right? Banks, they can create subsidiaries and go into some other business, or maybe related business or unrelated business, or because that is risky. If something happened to a subsidiary, right, that will have a huge impact on the bank itself. So there are restrictions, right? What are the investment a bank can make as a subsidiaries, right? So only in licensed banks. So subsidiary investment so can be on licensed bank. Others in related sectors or with the permission of the Monetary Board in certain companies, right? If they want to have other business subsidiaries, then they have to get a Monetary Board approval. A licensed bank shall not accord to any of its subsidiary companies treatment, right, which is more favorable than the treatment accorded to other constituent of the bank, right? The problem is you can see banks with subsidiaries. If banks, let's assume bank is going to give loans to its subsidiary, that interest rate for the loan cannot be favorable to the subsidiary compared to any other companies outside, because it should be arm's length basis. That's because like these regulations are very important, you know. Otherwise, the banks can give loans at a 5% to subsidiary. We are like outsiders outside. Any other entities are getting a 10%. It's a favorable treatment. So to avoid that, so these regulations are in place. And bank investment shares. So investment shares is a very risky business because overnight you can lose the money, right? Whose money? It's a public deposits, right? So then there are restrictions. So one, it says only in listed public company shares. The bank can invest only in listed public company shares. In special circumstances, Monetary Board gives approvals for some investment, that is for like for the requirement of financial system actually, right? So shareholding acquired by the bank in any listed company shall not exceed 10% of the bank's capital fund, right? You can't invest more than 10% of the capital fund, 10% of the bank capital fund, right? So bank side, let's say if you have 10 billion capital, you can only use 1 billion to invest, right? Second, not exceed 20% of the paid up capital of the company. So it's a company side. If you are going to invest in a company A, then you can maximum invest 20% of the paid up capital, right? An aggregate amount invested should not exceed 30% of the bank capital fund. Right? Okay. So these regulations are there, right, to look after the bank financials. Otherwise, like, even as I said, you can think of, right, in a complex situation. Now, if the shareholders can control banks, what will happen? So shareholders will direct bank to list in the any other companies, right? So anybody can play around if we don't have this kind of regulations. Clear? Okay. And we discussed earlier like capital requirements, reserve fund requirements, liquid assets requirements. So those are clearly stated briefly in Banking Act, right? We will see one by one. What are those? First, no licensed bank shall carry on business in Sri Lanka unless it complies with all requirements specified in Part 3 of the Banking Act dealing with the above, right? So, capital requirements, reserve funds, and maintenance of liquid assets. Right? It says, the first of all, the minimum equity capital should be maintained as determined by the monetary board. Right? So monetary board time to time say this would be the minimum equity capital. So banks are required to maintain that minimum equity capital. This minimum equity capital would be decided based on several covenants, right? Maybe total assets, maybe liabilities, or specified category of assets, and viability and stability of the banking system, right? So the minimum equity capital would be decided based on that. And to comply with those, or 12 months or longer period will be granted. And minimum equity capital will not be reduced without the approval of the monetary board, right? So these are stated there in with regard to minimum equity capital. Now you can see now the minimum capital requirement currently, domestic Lcbs for existing bank, right? Domestic Lcbs, that means the licensed commercial banks located or established domestically, it's a 20 billion. So licensed specialized bank, it's a 7.5 billion. Foreign banks, there are two categories. If the total assets is below 100 billion, they can have only 5 billion. Or if the assets are over 100 billion, so they have to have 10 billion minimum, right? But if there's a new bank coming in, right? So domestic, if it is a domestic Lcb, 20 billion, or domestic Lsb, 7.5 billion, but foreign banks, it's 10 billion. Right? There's no categorization based on the assets for new banks, but already existing bank, of course, that is there. Right? Actually, like banks were required to reach this or comply with this one as of 31st December 2020, but due to this pandemic, it has been extended to till 31st December 2022. Right? If like most of the banks comply with anyway, but if the banks are not complied, so then they have to comply before 2022. And new banks, of course, right? Domestic Lcb 20 billion, domestic Lsb 7.5 billion, and foreign banks 10 billion. Okay. So capital adequacy ratio. So what do you mean by capital adequacy ratio? Right? Earlier also I explained slightly, right? So how much a bank should keep a capital with regard to its risk-weighted assets, right? It can be 4%, it can be 8%, or it can be 5%, 10%. Okay, there are different requirements, right? So that's time to time, monetary authority or central banks require them to have it, right? But the capital adequacy ratio, we call it CAR, shall be maintained at all times. If the central bank says your capital adequacy ratio is 8%, you have to maintain this 8% all the time. This capital adequacy ratio are based on the guidelines issued by the bank for international settlements, right? We call it Basel requirements, right? Actually, the bank for international settlement, BS, they are the right they are the entities like time to time for financial sector development or bank supervision, or for so many reasons they give always publish the guidelines, right? So banks or financial entities around the globe, right, they comply with these guidelines, or they change according to their guidelines. They change their internal or local regulations or directions and follow as it is, right? When varying it will be communicated in writing, and 12 months or such longer period will be given, right? If there's a changes into those requirements, so that would be communicated in writing, and a period would be given to comply with, right? Because like some of the regulations, right, as I said earlier, the minimum capital requirement, so it's not easy, right? So raising capital is not an easy thing, because like it's very costly, right? And risky as well. So then sometimes the times may be extended. And if equity capital or capital funds of a licensed bank is deficient, the monetary board may grant a reasonable period of time for the rectification of such deficiency. Or like if some of the banks are not complying with the requirement, so monetary board can grant a reasonable time for that. So we discussed about capital, and the Banking Act talked about maintenance of a reserve fund. So Banking Act says there should be a fund the bank should create, right? That is called reserve fund. And how to create, how to accumulate reserves into that fund, it's clearly stated, right? It says all licensed banks shall, out of net profits before dividends, a transfer of profits to the head office, right, transfer sum equivalent to not less than 5% of such profits until the amount of the said reserve fund is equal to 50% of the paid up capital by assigned capital. Now, every time annually, the banks take their profit, calculate their profit. That profit should be before dividend or before transfer of profits to the head office. Calculate that and transfer 5% of such profit to this reserve fund until that reserve fund become 50% of the paid up capital. So annually they have to transfer 5% of their profit to that fund. Once the fund reaches 50% of the paid up capital, thereafter the bank should transfer 2% annually to at least to reach 100% of the paid up capital. So the reserve fund, right, should reach 100% of the paid up capital. Until such time, first you have to allocate 5% the profit and then 2% of the profit. Clear? Yes. This is maintenance of a reserve fund. And This bank can also talk about maintenance of liquid assets. Right now, earlier when we discussed, I said, okay, there's a liquid risk. So banks side, they have to take all these necessary actions to maintain liquidity of the bank. But liquidity is very important. We discuss. So then Banking Act also says, right, there should be a you know a requirement. There's a requirement to maintain liquid assets. We call it SLAR, Statutory Liquid Assets Ratio. So it says every licensed bank shall maintain the statutory liquid assets ratio as determined by the monetary board. It clearly says. So every bank should comply with this one. It should be like maintained in a daily average each month, right? It's not an end of month, it's not an end of quarter, it's a daily average. That means every day you should have sufficient liquid. That's a requirement. So now, how do you calculate this statutory liquid assets ratio? You take all liquid assets and divide by total liabilities, right? Multiply by 100. You should maintain at least 20%, right? That is the requirement. Okay. Now, what are the items you can take into liquid assets? What are the items you can take into total liabilities? It's given, right? Otherwise, what will happen? So like different banks take different assets as a liquid assets. Different banks takes different liabilities as total liability and calculate. It's problematic. So then it's defined. What are the liabilities you can take? What are the assets you can take? Right? The liquid assets in terms of Section 86 of the Banking Act. So Section 86 says what are the assets you can take. And then total liabilities means you have to take total liabilities and less liabilities to central bank, liabilities to shareholders and holders of non-redeemable debt instrument, and liabilities on repurchase agreement in relation to treasury bills you can remove, because you know why, right? Liabilities to central bank, you need to maintain liquid assets, right? Shareholders, okay, that's an indefinite period. So those liabilities you don't need to maintain liquid assets, right? But other liabilities, of course, because liquid assets will give you a buffer, right, to manage your liquid risk, right? But this is licensed commercial banks requirement. You know, like as we discuss always, we have two categories of banks: licensed commercial bank and licensed specialized bank. What we discuss is the requirement for licensed commercial banks. But licensed specialized bank, okay, this calculation based on their deposits. You have to maintain 20% on their deposits. The bad side of this is if any banks fail to maintain this, there will be a huge penalty, right? So if some banks miss this, their reputation under threat, and then they have to pay penalty as well. So it's very serious business. So that's what, like, all the banks try to comply as always. Now, as I mentioned earlier, the banks, they have two kinds of business: domestic banking business and offshore banking business. The unit which is carrying out the business called domestic banking business called DBU. DBU means a unit, domestic banking unit. That means a unit carries domestic bank business. OBU, offshore banking unit. That means a unit carries offshore banking business. Now here under Bank Act, it says authorized business carried out by a DBO. What are the business activities carried out by DBO? One is lending and deposit mobilization, borrowing from domestic sources or outside the country or from its own OBU subject to restrictions, making investments in government securities, equities, subsidiaries, and associates, maintaining branches and other banking outlets. Right? This is the DBO business. Lending to exporters, importers, corporates for other business, SMEs and individual. Mobilization of rupee deposits and foreign currency deposit. This also can be done. Right? Okay. And Banking Act also says, what are those offshore banking business? Right? As I said, first, you have to obtain the license. License must be obtained for offshore banking business. And a separate offshore banking unit, that means OBU, shall be established and carried out. Right? To carry out activities in accordance with the Banking Act and with the offshore banking business order, there's an order given, so you can read that as well. Right? You can see the activities. One, business with non-residents. Okay, keep in mind the offshore banking unit can do the business with non-residents. That means they can accept deposits, extend accommodation to non-residents. OBU to borrow any sum in designated currency. They can borrow foreign currency. So what are the foreign currencies? It's already designated. Engage in transaction any designated foreign currency with any other offshore unit, right? So bank to bank, you can have, like, bank A has offshore banking unit and bank B has offshore bank unit. So this bank A, bank B, those offshore banking unit OBU also can engage in transaction in foreign currencies, right? Engage in any other transaction authorized by monetary board, right? So if they can get a monetary, if there's different transaction businesses, they have to get the monetary board approval, right? With the minister's approval as well. To carry out offshore banking with the approval of the minister, the monetary board may authorize resident companies. Right? As I said, they can only deal with non-residents, but with the approval, they can deal with BOI companies as well. So BOI resident companies, right? Okay. In addition, when they do offshore banking business, they have to prepare, the banks have to prepare a separate balance sheet and profit and loss account in the form of specified by the monetary board. So monetary board would give a format, right? So based on that, so they have to prepare balance sheet and PN. So all these item what I'm explaining is I'm simply giving all this. It's in the Banking Act. So you read and compare and see, right, whether your understandings are correct. And also this bank had talked about accounts, audit, and inspection, right? So it says all licensed bank must prepare a balance sheet and P&L accounts for each year, right? Annex details on capitalized expenses, market value of investment, methods adapted to value of fixed assets, advances, cash flow statement, and on fixed asset reservation. So we should, when you read this, actually, like, it's a very simple, and other companies also doing, you will get that kind of impression. But what I want to say is these are the requirement to show that banks statements should be, or banks activities are should be disclosed publicly, and it should be very transparent and easily can be assessed. Because like if it's a private company, no worries, like it's a share, like owners of the company is going to take about any hit. But if it's a bank, then that's going to have a bad, like negative impact on the depositors and economy. So that's what all these details are required. All right. So failure to do so, then there will be a regulatory action on the banks, right? So that's what everything is given, right? So you can't say it's not required, right? And these details should be submitted in the specific form, right? All banks should transmit the financial statement to Director of Bank Supervision within 5 months after the close of the financial year, right? After, when you close the finance, let's say your close of financial year is 31st December 2020, then the bank should submit the finance statement before May. And also there's a requirement, they have to publish these finance statement in all 3 languages. That's what, like, whenever, like, regulators always say, right? You have to, any depositor or investor, you have to go through these finance statements, right? That is publicly available, and make your decision, wise decision, right? Okay. And also, like, Banking Act, right, says Monitor Board will issue guidelines for the appoint experienced and competent qualified auditors engaged in auditing of the bank, right? So who can audit the banks? So Director of Bank Supervision, so I should say, like, again, in central bank, there's a department called Bank Supervision Department. The head of the department called Director of Bank Supervision. So under the Monetary Act, the power is vested with Director of Bank Supervision Department, clearly, right? So under the power, and Banking Act also given so many powers to Director of Bank Supervision. So Director of Bank Supervision, time to time, they issue so many directives, right? With the Monitor Board, Aprolo Monitor Board issues so many directives. So one of the list is the qualified auditors list. So Director of Bank Supervision will issue a list of qualified auditors. Only those auditors can audit the banks. And auditors shall submit within 3 months from the end of the financial year the audit opinion, right? So auditors, they have to do the audit and submit within 3 months their audit opinion to Director Bank Supervision. And also stated, audit fee will be borne by the licensed bank, right? Okay. And Banking Act also says Central Bank of Sri Lanka to cause an examination. That means the Monetary Board from time to time cause an examination of the bank to ensure financial soundness, right? What happened is, now the banks are under supervision. So time to time, the Bank Supervision Department under Director of Bank Supervision, they visit the bank, right, and perform the examination and ensure that there's like, the financial soundness is there. So foreseeable future, in foreseeable future, the bank is having no issues, kind of, right? Or like sustainability is ensured, right? So the central bank can do the examination of this financial institution or banks. So this empowered to look at any books, minutes, accounts, cash, securities, vouchers, and other documents. Okay, you can go to bank, you check anything, right, to ensure financial soundness of the bank, right, or even its subsidiaries as well. Clear? Right. And very important aspect here, not only these criteria, but also Banking Act talked about the fit and propriety of managerial personnel in banks, right? When you say managerial personnel, maybe like directors or chief executive officers or officers performing executive functions and board secretaries. So these are the key management personnel in the bank, directors and key management personnel of a bank. So they should be fit to the post, right? And their suitability is always assessed by the regulator, right? So suitability can be assessed in with the various criteria. One is their academic or professional qualification or experience, right? Or their integrity, their age, number of years in service, representation in boards of number of companies. And these information all collected through an affidavit and declaration. So when a person is appointed under this KMP, Key Management Personnel or Director, they have to send, bank should send affidavit and declaration, right? Especially affidavit. With all these, there's a format. So with those formats, so they have to fill all this information and send it to Director of Bank Supervision. And that should be evaluated. And those application, if the application is within the expectation, right, or required level of fit and proper, then of course approval is given. Otherwise, that will be rejected, right? A director or an employee shall not be appointed to another bank unless it is a subsidiary. That also we have to remember. Executive director shall not exceed 1/3 of the number of members of the board. So these are given, right? And there are like directions issued under each and every areas. You can go through and see, right? I think like recently 2019 there's a direction, so you can read that as well. So it clearly says what should be done when they appoint a key management personnel or CEO, right? So I was telling like key management personnel officers performing executive function. So that's also listed in the directions, and you can see the monitor board has determined that the following officers perform executive function. So when it comes to key management personnel, who are the key management personnel? There will be a question. So you have to define that. That's what I earlier said. So you have to define so many things. So there'll be so many directives, right? So example I have given. So you can go through this example and think, okay, it's a top level management, right? Right? Senior managerial level people, right? So maybe AGM, DGM, right? Chief of departments, right? Board secretary, head of treasury, something like that, right? You can see. And also it says, right, the central bank can have control over the licensed banks through various means. One of the ways is like director of bank supervision can issue an order if the bank is engaged in unsafe and unsound practices, right? If director of bank supervision finds that, okay, this bank is engaged in unsafe and unsound practice, and that will lead to a loss of deposits, then definitely they can issue an order. And if the banks are contravene the provision of the act, definitely there can be an order issue. The Monetary Board can issue directions to licensed bank in order to ensure that the soundness of the bank system regarding the manner in which any aspect of the business of such bank or banks to be conducted, right? So Monetary Board, as I said, like always, they can issue directions, right? How to conduct a banking business, or that's the more or less we are going to give a regulatory framework. That's what I say, right? It can be act, or it can be direction, it can be order, it can be circulars, it can be a guidelines, anything. So through that, there will be a regulatory framework established. So the bank should conduct their business within that framework. Okay, now finally, I just want to tell about something about Sri Lanka deposit insurance scheme as well. So actually, like this is also very important measures taken to safeguard the depositors' money. And now, like the regulators, like if you take Central Bank of Sri Lanka, the one of the core objective is to maintain financial system stability. So for that, so many regulatory frameworks, examination, continuous supervision, everything is there. But still, sometimes bank may fail, right? So then there should be some kind of insurance backed up, right? So it's in so many countries that's available. So it's a safety net tool, we call it, right? So through the safety net, you can enhance public confidence, because like public can feel, okay, yeah, even the banks fail, we can get the money through deposit insurance scheme, right? And same time, it lead to like small deposit holders, right? Sorry, small deposit holders could be protected through this. So like it will bring all the people into the banking system, right? Now this banks, how this scheme works, like bank should pay premium quarterly to the fund. So central bank will operate and manage that fund. And if something happen or to a bank, or like cancel, if the license cancel, then there will be a compensation from this scheme, right? You also can read it's there how these compensations are given, right? So this is a safety net tool, Sri Lanka deposit insurance scheme, right? Okay, so I have covered the regulations, and then today like financial intermediary. So we discussed mainly 5 areas. One is throughout the class, one is overall view of financial system, interest rate analysis, exchange rate analysis, monetary policy, and then financial intermediary and regulations. Okay, so I hope you would be like understood what we discussed. And if you have, because it's a huge area, right? So we have to like summarize the things and give it to you. And I highly encourage you all to read the books, and as much as possible you read the Central Bank of Sri Lanka website, browse and see some important areas. And then you can you know, the questions will be within this area. So you can, if you can clearly understand all these items we discussed, of course might be easier. And okay, if there's any questions, I can answer now. Otherwise, like there will be like the other areas will be followed by my lectures. So as I explained at the beginning, and in the more like when we start this class as well. So these areas, okay, I hope I have done. So if you have any question, you can send me a message, and I will yeah, I will yes, you can I think you can talk to IBSL and get the past papers. It's a very good idea if you can yeah, try to do that as well. I just you can see my email address. uh, okay, this is my email, right? You can if you have any doubt, you can send me the email as well, but the only thing is you should be specific to the question and very short one, right? So you can't expect a paragraph and paragraph from me, and you also refrain from sending uh, explanatory things, right? So then just you can keep very short, and if there's any doubts, so then I can in point form I can answer your questions as well. Okay, so then try to get the past for yeah, past papers from IBSL, and you can go through that as well. Okay, that's it from my side, and thank you so much for joining with us for these discussions, uh, and okay, good luck. Thank you.